Good afternoon everyone, here's your market update. So let's start with the US dollar. In the past 2 months, the markets have moved between hopes for easier Fed policy and renewed worries about the inflation. So the expectations for a dovish shift reached their highest point since 2023 before this week's meeting. The Fed did cut rates by 25 basis points, but its cautious tone caused the US Treasury yields to rise and the dollar to hold firm. And right now, the market expects between 1 and 4 more rate cuts in the next 12 months, but not a deep easing cycle. Even during the softer market conditions earlier this year, traders avoided pricing in a full recession. Our economists still think another rate cut is likely in December, but the Fed's careful approach should keep the US dollar supported in the short term. So moving on to WTI crude oil. The US has increased its military presence near Venezuelan water, targeting suspected drug trafficking vessels and raising regional tensions. If that continues, Venezuela's roughly 1 million barrels per day of heavy crude exports could face some disruption, which may give oil prices some short-term support. However, a major supply shock looks unlikely. Washington's focus is mainly on drug and immigration issues, not oil, and Venezuela depends heavily on oil income, so large shutdowns are improbable. But still, even small interruptions could tighten supply and narrow the price gap between light and heavy crude. And finally, gold is pausing after a strong rally and is now consolidating below the $4,000 level. And November and December are usually slower months for gold ETFs, and a short pullback over the next few weeks would be a healthy correction in the long-term trend. And after hitting $4,360, the ETF holdings dipped slightly but remain well below the 2020 peak. I expect new highs in early 2026, with $5,000 still a realistic long-term target. Any short-term dips should stay shallow thanks to strong central bank buying, a steady inflation, and also safe haven demand. So that's all for today's review. Thanks for listening, and we'll continue to watch the market reactions closely after the Fed's latest move.